What are some of the key caveats let's do percent of sales approach first. Again, one key ratio here involved is CIR, capital intensity ratio. We said in session 3, that's the inverse of the asset turnover ratio, asset turnover being sales over assets. So CIR is assets over sales. It's a reciprocal or 1 over the asset turnover ratio. And for Rosengarten, it took $3,000 in total assets for every $1,000 in sales. In that example we just looked at, that's a 3-to-1 capital intensity ratio. So that tells me that Rosengarten is fairly capital intense. You can, again, compare this ratio to other companies in your industry and across the world for that matter. EFN is also known as the plug. How much do I need to plug in? In the last example, it was $565. If that were in millions, that'd be millions of dollars. And then where do we put that? Where do we plug that in? We need to plug that in if we need to grow that fast, 25%. The higher the rate of growth in sales or assets, the higher the need for the plug or EFN. Hoffman Company, let's look at Hoffman Company, EFN. So similar example, this time a lot quicker. I take, and this is the way we do forecasting, I take actual results for Hoffman from last year. Note that Hoffman only wants to grow 20%. So I take column A times 1.2 to get column B. I can also use percent of sales approach. I would take cost divided by sales, taxes divided by sales, and multiply that by the new sales number to get the forecast numbers. That's another way of doing it. You can see that Hoffman did pay dividends. They also paid 1/3 out and kept 2/3. So of their $66 million, they paid 22 out. So we figure we did that last year. We can do it again next year. So of our $79.20 in net income, we will pay out 1/3 and we will keep 2/3, just like we did last year. We feel very confident doing that. Why? Because we did it last year, and we can do all those ratios again that we covered in session 3 on this income statement and on the Hoffman balance sheet. So I gave away 1/3 of my net income, and I kept 2/3 of my net income, and we'll forecast that same ratio going forward. Once again, I would take the column A times 1.2 in this case because I'm only growing 20%, and do the same thing on the asset side of the balance sheet. Note that in the Hoffman example, debt and equity do not grow with sales. So costs vary with sales, assets vary with sales, debt and equity do not. And so I'm going to leave those the same first time through. So 250 and 250, but I must remember to bring in my 5280 from the balance sheet that I'm keeping. Those are my additions to retained earnings. They're going to get plugged in to the equity account, as you can see here. So that number will be 250 plus 52.8. And then I'll ask myself again, am I balanced on this balance sheet? And the answer is no, I am not balanced. I must plug in $47.2 million to balance this balance sheet, and that will be my plug for external financing needed, simply by taking 600 minus 552.8, and the 552.8 is gotten by taking my total debt plus total equity. Total debt didn't change, total equity didn't change, but I did have to add in that 52.8 of money that we're keeping, plowback, that we're keeping out of our net income. So with that unbalanced, I still need to add an additional $47.2 million to balance this balance sheet to get both sides of the balance sheet to read $600 million. And that's what I would do. And then you have to take action on that. You have to go to the banks or go to financial district and go secure $47.2 million in debt. Now, what happens to my ratios if I do that? Does it destroy my ratios? Last year, if you look at this balance sheet, debt to equity was 1-to-1, a little on the high side, but we survived. So we're going to try that again, or better. Hopefully, if we can get that debt to equity ratio down, that would even be better. So the question is, what happens if we put that whole 47.2 plug into debt? Okay, we put it all into debt. That's one possibility. And see what the ratios are. If that kills our debt to equity ratio. So we notice that our debt to equity ratio was 1 last year. What will it be if we put $47.2 million more? Well, because the equity account also went up because of the additions to retained earnings, that our total debt to equity ratio actually goes down to 0.98 times. So that's actually good. So yes, I'm going to probably put all of the plug into debt. I will go visit the banks. I will increase my total debt, and I'll actually improve my debt to equity ratio. So it would all be good, and it would probably get approved. Debt is very much less expensive to get. You can simply go to a bank and take out debt or float some bonds, which tend to be a little bit easier and cheaper to float than equity if I were to acquire additional equity. What are different ways I can calculate pro forma projected values? Well, I gave you several of them. Just the factor up approach, percent of sales approach are two of them. Sometimes just subtraction. I can do simple subtraction to get these projected values. What value do you use from the pro forma income statement in the pro forma balance sheet? You need that additions to retained earnings. Circle it and you bring it over to the income statement, because that's what happens at the end of the year. It's what the accountants actually do. How do you find the plug? You take your total assets and the new numbers minus your total liabilities, and see if the liabilities plus equity. If the balance sheet is balanced, there is no plug. If the balance sheet's out of balance, you must plug it in and put in a debt or equity plug. How do you know you can add it on which line of the balance sheet? Well, you have to do ratio analysis. If the move you're making ruins your current ratio or your quick ratio or your long-term debt to equity ratio, you want to go back and revisit the question, do we really, really want to grow that fast? And maybe we can get by with growing a little less quickly, and we can take on less of a plug and less destruction to our financial ratios.